Is the IndiaFirst Life Tulip plan your gateway to wealth creation and protection, or is it just another ULIP with fancy packaging? Let us find out through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. But before analyzing this policy, let us first understand a few basic details about it. So this is a non-participating unit-linked individual savings life insurance plan. Some of the key features of the policy are: you get to protect your family with a life insurance cover of up to 50 times your premium, and you also get to receive your fund value as a maturity benefit at the end of the policy term. You get to choose from 10 diverse fund options based on your risk profile and financial goals, and you also get to boost your savings with the return of premium allocation and return of mortality charges, and you get to enjoy unlimited free switches and premium redirection to optimize your funds performance, and there are potential tax benefits available as per your current tax laws. And you also can strengthen your coverage with optional riders like the accidental death benefit and total and permanent disability benefit, and you get to pick from multiple investment strategies tailored to help grow your savings effectively. And there are benefits like death benefit, maturity benefit, and return of charges. So these are some of the benefits you can get from this policy. And also, as a unit link policy, there are charges that they will deduct from your premium, like fund management charge, mortality charge, premium allocation charge, policy administration charge, and discontinuance charge. But there are not other charges that they deduct, like partial withdrawal, revival, and switching charges. Although the plan does refund certain charges, it doesn't account for the time value of money, and moreover, some charges are deducted regularly throughout the policy term. So what happens over time is these ongoing deductions can significantly erode your investment value and reduce the long-term returns. Now let us take a look at the advantages. You get to enjoy unlimited free fund switches to adapt your investment strategy as your goals evolve, and you also get to access your accumulated funds through partial withdrawals in case of financial emergencies. And from the second policy here, you can redirect future premiums from one fund to another, offering greater flexibility. And you can customize your policy by changing the premium payment frequency, extending the premium paying or policy term, or even reducing the sum assured as per your changing needs. So these are some of the advantages. However, the disadvantages are this plan has a 5-year lock-in period restricting yearly access to your funds, and only the net premium after deducting various charges is invested, reducing the effective investment amount, and the risk return trade-off is unfavorable, making it a less efficient investment option. And there is no loan facility available under this plan, limiting liquidity during financial emergencies. So you need to consider all these drawbacks before deciding to invest in this policy. And if you want to understand a certain aspects of the policy in detail, you can refer to the policy brochure. So now, as we have a basic understanding about this policy, let us now move on to the analysis part of the video. So here, to help us make a more informed decision, we are going to conduct an IRR analysis where we are going to calculate the internal rate of return of this policy based on the benefit illustration given in the policy brochure. So for calculation purpose, let us consider the case of a 35-year-old male who has opted for a sum assured of 30 lakhs with a policy term of 15 years and a premium paying term of 6 years. So the annual premium is 1 lakh and the maturity benefit is payable at the end of the policy term. So here the returns are projected under two scenarios in the policy brochure, assuming investment returns of 4% per annum and 8% per annum. So these projections are not guaranteed and they just serve only example purpose. So this is just to show you how this policy can perform at worst and best case scenarios. So under the 4% scenario, the projected fund value is 7.13 lakhs, translating to an IRR of just 1.39% as per the policy's maturity maturity calculator. Under the 8% scenario, the projected fund value rises to 11.18 lakhs with an IRR of 5.08%. So these figures reveal that the plan delivers subpar returns even under the higher return assumption. So the low IRR suggests limited wealth creation potential, increasing the risk of failing short of your financial goals, and for long-term investors seeking meaningful growth. So this policy does not offer compelling value as an investment avenue. So these are some of things that you need to consider before deciding to invest in this policy. But now, as we know that this policy is not giving us the desirable outcome that we need, let us move on to the comparative analysis part of the video, where in the previous scenario, as you can see, this policy had a sum assured of 30 lakhs with an annual premium of 1 lakh. So we are going to split the 1 lakh by investing in insurance and investment separately just to see whether it can perform efficiently. So for a fair comparison, we are going to consider a pure term life insurance policy for life cover purpose with the same higher sum assured of 50 lakhs instead of 30 lakhs, because the premium is just going to cost us for an annually 17,200 rupees for a 15-year policy term with 5-year premium paying term. So by choosing term insurance, we get to save 82,800 rupees per year, which can then be invested based on your risk profile. You can opt for safe instruments like PPF for stable tax-free returns, or choose equity mutual funds for higher market link growth. So let us now assume the saved amount of 82,800 is going to be invested in an equity mutual fund, because as we are going to compare this alternative with another this policy where it also has risk, it will be a fair comparison. So the projected maturity value is 21.40 lakhs, and after accounting for the capital gains tax, the post-tax value is 19.52 lakhs. So this results in a post-tax IRR of 9.79%, which is far superior to the 5.08% IRR offered by the IndiaFirst policy at an 8% assumed return rate. So if you have any doubts regarding how we have calculated the tax for the equity mutual fund, you can definitely see that we have a small tabular column presented on the screen for your easy reference, which you can pause and see. So this alternative strategy offers us with higher returns that beat inflation, greater flexibility to align with your goals, and liquidity which ULIPs generally lack. So by separating insurance and investment, you not only get adequate life cover but also maximize wealth creation. Unlike ULIPs, where returns are compromised by charges and lock-in periods, this approach empowers you with control, efficiency, and better financial outcomes. So what is the final verdict then? Is investing in the IndiaFirst Life Tulip plan worth it or not? So this policy combines life insurance coverage with a market-linked investment option. On death or at maturity, the benefits are payable either as a lump sum or in installments. Beyond this, however, the plan functions like a standard ULIP, which is known for delivering suboptimal returns. Upon analyzing the potential outcomes, it becomes evident that this plan does not help build a substantial corpus over time. Furthermore, the sum assured may be insufficient to offer meaningful financial protection for your family. So choosing this policy may in fact hinder your investment journey, as it also has a high agent commission. Relying on a combination of term insurance and a unit-linked insurance plan is not an effective approach for meeting your financial goals. Instead, consider purchasing a pure term life insurance policy for comprehensive risk cover and invest the rest separately in instruments aligned with your goals and risk appetite. This strategy provides better returns, higher liquidity, and greater flexibility compared to ULIPs.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.